Hello, everyone. It's Robert Johnston here. I am the Director for Energy and Natural Resources Policy at the School of Public Policy at the University of Calgary in Canada. I recently joined the University of Calgary after 5 years running the Center on Global Energy Policy at Columbia University in New York. And as many of you know, Columbia University went through some challenges in terms of everything happening in Washington. And being from Canada, it was a great time to come back to a Canadian university, not just because of some of the problems in the US, but I was actually quite excited to see something happening in Canada in the oil and gas and natural resources sector with our own new government here with Prime Minister Mark Carney. So I'm working on a lot of US-Canada issues, and most of my career has been focused on the geopolitics of energy, which is the focus of my presentation today. My colleagues at Columbia continue to do really great work at the Center on Global Energy Policy, and I encourage you to look at their work as well. So I'm sorry I can't be there in person. I had some illness in my family, but happy to have a chance to share my thoughts with you all here today. So I'd like to touch on four topics in my 20 minutes or so that I have available to discuss today. The first is the geopolitical context for the Norwegian oil and gas sector. Then I'd like to touch on the supply side of the oil market, particularly looking at OPEC Plus and US shale. Then briefly touch on the oil demand picture, particularly looking at what's happening in China and also in the emerging chemical sector. And then wrap up with some comments on LNG, where there's some important trends we want to highlight here as well. And while I'm not an expert in the Norwegian oil and gas sector, I do want to link some of these global trends back to what's happening in Norway as well. So just to start with a bit of history, which I think many of you will be familiar with, on this slide, we're looking at some of the pictures of Norway's oil and gas sector's origins with our Ecofisk platform there, but also other things were happening in the world over the last 30 or 40 years, which I call the age of energy insecurity, which probably began in the oil shocks in the early 1970s and continued all the way until the US shale market really opened up around 2014 or so. At that time, there was a lot of talk about peak oil. There was a lot of nationalization taking place. There was a lot of talk about a producer-consumer dialogue between, IEA member countries and OPEC. But the major theme was energy insecurity, real concern about prices and availability of sufficient supplies of oil and gas. In geopolitical events like we see here, the war in Iraq, the gas shortages, revolution in Venezuela, the rise of Chinese demand, all played a key role in that age of insecurity. And it's those kind of global factors that really drive supply and demand. Things like spare capacity within OPEC, the kind of growth we see economically out of emerging markets like China, and more recently, the trend of electrification of energy-intensive sectors like transportation. Those trends are the ones that really drive upstream investment globally. And you can see in our chart here on page 4 that global upstream oil and gas capex peaked around 2014, bottomed out in 2020, and has come back in 2024, pretty close to where it was in 2014. And what I would say is that those global trends, in many ways, influence how much spending we're going to see on upstream oil and gas capex around the world. But it's the domestic factors, policy and regulatory environment, competitiveness of projects that shape the portion of that investment that each country will get. So decisions made in Norway will influence Norwegian's competitiveness within this spending of oil and gas capex around the world. And that's true for every major market as well. So what we can see here on page 5 is that if we break that upstream investment down in a little bit more detail, we've had the yellow line here, which shows upstream oil and gas investment by company type over the last 10 years. It's really been national oil companies from the Middle East and Asia that increasingly account for the largest amount of upstream investment. And what we see is that other national oil companies, the super majors and the independents, they have not really recovered since 2015 in terms of the amount of upstream investment they're making. The private companies in the US in particular and in Canada are buying back shares, they're investing in dividends and not doing as much upstream investment. So in the previous slide, when we saw upstream investment recovering, it's really being driven by Middle East and Asian national oil companies. The Saudis, the Emiratis, the Chinese stand out in particular. What are the geopolitical contexts for Norway today? I think there's four different trends to consider. Certainly the war in Ukraine and Middle East. The climate crisis has not gone away, even though it's not a major focal point for the Trump administration. The key trends around technology, things like electrification and decarbonization, and then something that hasn't often been front of mind for oil and gas markets, the question of industrial policy, trade policy, and deglobalization. So when companies look at investment in the oil and gas sector on the upstream side, these are the factors that are driving thinking today in the same way that that age of energy and security drove a lot of the upstream investment in the 70s, 80s, and 90s and early 2000s. All right, let's spend a minute talking about OPEC Plus. I think it's fair to say that Saudi Arabia remains an important swing producer. And I think that's true not just in terms of their ability to balance the market, but also balancing relationships, the US, Russia, and China. And now that the US is more of a producer state, that's become even more complicated. But what we've seen here in this chart, going back to the past several times when we've seen Saudi play a big role as a swing producer, up to and including to today, is that it's really the Saudis that have the spare capacity and that are really not afraid to use it when they need to help rebalance the market. Whether that's dealing with oversupply in the late 1990s, reacting to the rise of shale in the mid 2010s, reacting to COVID in 2020. And now in 2024, 2025, we see OPEC actually adding production, mostly Saudis using that spare capacity to take back market share. So that constant push and pull between market share and price is something that will continue to be a key factor. Will we see another market share war? I mentioned that the Saudis and OPEC are increasing production and increasing it into a fairly slow market, frankly. But I think they're doing so in large part because of the US shale. In 2015, they were concerned about a rapid ramp up in US shale supply. I think in 2025, the Saudis see an opportunity because the US shale markets are actually slowing down. There's not much expectation that US shale will go beyond 14 million barrels a day and actually might decline further. So that's a significant trend we need to watch as well. Now, will the US shale be a swing producer in the same way that the Saudis are with their spare capacity? We used to think that shale was very much a market-driven phenomenon, unlike some of the national oil companies where it's more government-driven, and that supply was highly elastic. But arguably, I think the Trump administration is introducing more of a political aspect into shale production that we'll have to keep an eye on here as well. So let me talk about that from the US perspective for a minute or two. I think it's important to note that there's some tension in the Trump energy policy. He is very focused on cheap energy as part of an overall industrial strategy to attract investment in manufacturing back to the US. Yes, there's tariffs and there's currency devaluation and all kinds of subsidies and deregulation, low taxes, but cheap energy is a very important part of it as well. Now, for Trump, I think it really is a question of cheap energy, not clean energy. This means things like extending the life of coal-fired power plants, fast-track permitting for drilling in Alaska for new nuclear power plants, new transmission lines, new gas pipelines, canceling things like offshore wind and carbon capture projects. And we're really seeing electricity demand shift from electric vehicles and electrolyzers and heat pumps, kind of a Biden green industrial policy, towards things like AI and manufacturing. Now, that suggests that Trump is actually concerned about the availability of energy, particularly electricity, and his main focus is not increasing drill baby drill oil and gas production at all costs, but actually making sure that prices are fairly stable. In fact, low prices are better. Now you can see the contradiction here. If you're focused on low prices for oil and gas, you're unlikely to get a large response on the supply side from the upstream because prices won't be high enough to see more shale production. That's exactly what we're seeing happen. So, like I say, Houston, we have a problem. Some of the data on this slide looks at statements that the oil and gas companies made in the recent Dallas Fed survey, complaining, frankly, about Trump's energy policy. So we're seeing U.S. shale producers complain about Trump. Um, and what they're complaining about is a focus on Trump's focus on low prices. And that means a tension between the oil and gas producer side, which wants higher prices to encourage more production and more investment, with the consumer side, where the focus on inflation, affordability, and maintaining low prices. So this is something that is a real conundrum, I think, for the Trump administration to manage going forward. Now, we can't talk about the Trump administration and not talk about geopolitics. And this slide shows a great book that my Columbia colleague Edward Fishman wrote about the age of economic warfare and the idea that we've moved from the age of globalization to the age of economic warfare. And that means things like sanctions, export controls, and tariffs are becoming the primary instrument of state power. And I think from an oil market perspective, sanctions are a critical aspect of this, without a doubt. And even in the last few weeks, we've seen the U.S. Directing more secondary sanctions targeting China and India to limit their purchases of Russian crude oil. But again, you see that tension between energy dominance and energy abundance. Will Trump really push these sanctions, or is he concerned that shutting in Russian production might lead to higher prices that would go against his energy abundance agenda? And of course, we also have to be concerned that it looks like increasingly Trump is using sanctions, export controls, and particularly tariffs, not just against U.S. adversaries, but against U.S. allies or traditional allies as well. For Norway in particular, like Canada, middle power countries, we have to get used to competing in a post-institutionalist world. I think the U.S. is tearing down many aspects of the international order, World Trade Organization, NATO, World Health Organization, and there's also deinstitutionalization in the U.S. domestic system as well. So that looks like not a great picture for the global economy, and particularly for trade-sensitive commodities like oil and gas. Another quick word on the demand side. I think about Norway and the kind of oil and gas that you're producing, and particularly on the oil side, the key question of what is the global demand picture going to look like? And what I think is interesting, what I'm tracking here in Canada, is that increasingly the demand growth is not just in Asia, which is not new, but a lot of the demand that we're seeing for crude is actually coming in the form of demand for naphtha and for LPG as an input to the chemical sector. So that's going to have some important impacts on the types of crude that those Asian refiners want, along with these geopolitical factors that we discussed previously. What this chart shows is that over the next 5 or 6 years, according to IEA, demand for LPG, ethane, and naphtha is expected to grow quite strongly in Asia, whereas traditional demand for gasoline is expected to fall. Now, if you are following this, you'll know that that gasoline demand has a lot to do with the decline in China, which has a lot to do with the rise of electric vehicles in China as well. And that's going to be significant as well, for particularly for those producing lighter sweet crudes. And this really reflects the fact that a lot of the big new refineries that are being built in Asia really do have a strong demand for what we call crude to chemicals, not just crude to refined products, but also integrated refineries that can produce products like ethylene as well. So from a Norwegian perspective, it's important to think about how that change in the refinery complexes in Asia, which where the demand growth really is concentrated, what kind of crudes they're really going to want. Let me wrap up with a few minutes on the LNG, which of course is important for Norway as well. Again, my focus is very much on Asia from an LNG perspective. And for Norway, the more LNG demand there is going to be in Asia, I think the stronger that positions Norway in the Atlantic Basin market. Because eventually, what you'll see in that scenario is a lot more demand for US cargoes when the demand is there in Asia to go west from the Gulf of Mexico through the Panama Canal into the Asia Pacific market. Over the last few years with the war in Ukraine, we saw more US gas going to Europe, and that will continue. But I think the demand side that we're going to see in Asia with coal switching, with the rise in cooling demand for air conditioning in Asia, and of course, artificial intelligence and data centers, both in the US and in the Asian markets, will really pull a lot of US LNG into the Asian market. So we know there's a mega supply coming from the US with several new projects under construction. On top of that, we have a lot more Qatari gas coming with the Europeans trying to phase out Russian LNG imports. Um, now, and of course, big new pipelines proposed from Russia to China as well. Some people say that all that adds up to a gas glut, meaning lower prices. But there's an interesting question for LNG, which is quite relevant to Norway, which is if we're going to have a glut of natural gas and LNG supply, will those lower prices stimulate demand in the price sensitive markets in Asia, places like Pakistan, the Philippines, Thailand, that have strong economic growth, but typically have been reluctant to buy LNG when prices are high? If we have this big supply response coming, will that actually stimulate more demand due to lower prices? I would think the answer is probably yes. Other trends to watch, we can see that China continues to build a lot of coal-fired power plants. Coal power plant construction is outpacing natural gas power plant construction. The light blue lines in this chart are the coal plants being built. The dark blue lines are the natural gas plants being built, and there's a lot more coal being built than natural gas. Again, will cheaper natural gas, cheaper LNG switch this trend to see more demand for natural gas? What about data centers? I certainly agree that that will be a major source of electricity demand, and that part of that demand will be met by natural gas. What's interesting here is that the IEA data, their latest forecast on energy demand from AI and data centers, basically suggests that after 2030, a lot of the electricity demand will be met by renewables and nuclear. And they basically show a peak in demand for for coal and natural gas in the data center world. I'm somewhat skeptical about that. I think all fuels will be needed to meet the AI demand going forward, including coal and natural gas. But as important as AI is, we shouldn't also forget things like appliance and cooling demand, particularly in Asia, which again, according to IEA, is actually expected to grow faster than data center demand, in part because of that industrialization in Asia, emerging consumer class, but also the changing physical climate. The demand for cooling in many emerging Asian countries, South Asia in particular, is driving energy demand. And as you can see in this chart, that demand growth is actually expected to be stronger than what we're seeing for data centers. And just to give one example, in Southeast Asia, electricity demand is expected to grow at 4% annually, with the growing use of air conditioning amid more frequent heat waves, the biggest driver. So again, that's not to say that data centers aren't incredibly important from the energy perspective, natural gas perspective, but certainly cooling will be a big part of it as well. And lastly, I do think from a Norwegian perspective as well, looking at what's happened to shipping and maritime markets for the natural gas side, it is true that the US under Trump kind of pushed back this International Maritime Organization effort to move to cleaner fuels and decarbonization for shipping. But even though that isn't going well at the moment with the lack of US support, I do think the growth of LNG, of ammonia, and methanol for the shipping sector will be an important trend for your to watch as well. Okay, last but not least, in conclusion, how do we look at all this from a Norwegian perspective? I think the question of I started at the beginning, the global context for oil and gas investment, what are the major themes? Uh, those themes will drive the overall level of investment in the oil and gas sector, and then Norway is competing for its slice of that. I wrote a study for the Atlantic Council a few years ago that's cited here, which basically looked at if oil demand starts to peak and then slow down, what will the impact be on the current group of major oil producers? And my conclusion was that slower oil demand will probably have the greatest impact on what I call the fragile and failing states, particularly within OPEC. Excuse me, countries like Venezuela, Libya, Algeria, Nigeria, Angola, Iraq, etc., which may have low production costs but have a very high risk premium due to political instability. By contrast, I think what I call North America plus, including Norway and Brazil, countries that are more OECD type countries that have a stable investment climate, and most importantly, the technological sophistication in their upstream sector will continue to attract investment, even in the slowing oil demand picture. And that's certainly true for the technologically sophisticated companies in the wealthy Gulf states as well. Now, when I wrote this study, Russia was in a very different geopolitical position, but I think with the sanctions and underinvestment there, you're going to see a slowdown as well. So the bottom line is, I think the Norwegian Outer Continental Shelf will be a resilient oil basin and gas basin as well. But like other countries, there'll have to be a very strong focus on these geopolitical trends and market trends that shape the overall pool of capital available for upstream investment. Thank you again for inviting me. I'm sorry I couldn't be there in person, and please email me if you have any questions on this presentation. I wish you the best of luck with your conference. Thank you.